Business Stories live from the Sky News City studio. Shares of Metro Bank fall by 26% as it confirms it's exploring options to raise hundreds of millions of pounds in new capital. Rental prices reach a record high, up 10% from a year ago. And the competition regulator is to investigate the dominance of Amazon and Microsoft in the UK's cloud market. Good morning, this is Business Live with me, Ian King. Now, shares of Metro Bank have fallen by as much as 29% at one point this morning, and trading in them was briefly suspended as the lender confirmed it's exploring options to raise hundreds of millions of pounds in new capital. Metro is said to be in talks to raise £250 million via a sale of shares and a further £350 million in debt. Well, with me now is our City editor, Mark Kleiman, who broke the story last night. Mark, what's the latest?
Well, the latest is, as you've just mentioned, Ian, that Metro Bank's shares are in free fall. I suppose, to some extent, the reaction of the share price was predictable. A company with a market valuation of less than £100 million, which wants to raise at least that much again through issuing new shares, is not going to get a positive reaction from the market. But, of course, Metro Bank has been here before. Back in 2019, it had to announce a share placing to raise £350 million. It's been beset by perennial concerns about the state of its balance sheet. One of the issues that Metro Bank faces alongside that trouble it's going to have in terms of raising equity in is that it also faces a £350 million bond repayment, which must be repaid by this time next year. So the bank is positioning this as prudent capital planning, but the share price response this morning betrays the fact that investors are very jittery about Metro Bank's continuing financial difficulties. I should point out, Ian, there is no immediate threat to Metro Bank's solvency. There's no suggestion at all that it's on the brink of collapse. But what its board is going to have to do is think outside the box a bit about some other capital raising options. Now, these might include things like asset sales. I'm told that a £3 billion mortgage book may well come onto the market in the coming weeks if that equity raise looks too challenging. And indeed, the board may well feel pressure from regulators to think about selling the whole company. There's no hint of that in this morning's statement, but I suspect that that's one of the options that the board of Metro Bank, chaired by Robert Sharp, a veteran banker, will be looking at before too long.
All right, thanks for that, Mark. Some other business news stories for you now. And the Competition and Markets Authority has been asked by the communications watchdog Ofcom, as expected, to investigate the public cloud infrastructure services market. Ofcom said that having completed a market study, it had identified a number of features in the supply of cloud services that make it more difficult for customers to switch and use multiple cloud suppliers. It noted that Amazon Web Services and Microsoft had a combined market share between 70 to 80% in 2022. Google, which is their closest competitor, has a share of 5 to 10%. The tobacco and vaping giant Imperial Brands said this morning that price increases would help it deliver full-year profits in line with expectations. The company, whose brands include Lambert & Butler, John Player Special, Gauloises and the vape brand Blue, said it had gained market share in the United States, Spain and Australia, which had more than made up for declines in Germany and the UK. There was no word from the company on Rishi Sunak's proposals to ban the sale of cigarettes to anyone born after the beginning of 2009. Shares of Pandora surged by more than 9% this morning after the owner of the world's largest jewellery brand said sales and profits in coming years would be better than expected. The Danish company, well known for its customisable charm bracelets, said it was now targeting a compound annual growth rate of between 7 and 9% for 2023 to 2026. But the company warned that growing in China, where it had set a long-term target of trebling its 2019 sales, was going to take longer than expected. A majority of chief executives are expecting a full return to in-office working by 2026. That's a key finding from KPMG's annual survey of more than 1,300 chief executives, 150 of them here in the UK, of the world's largest businesses. The survey also reveals that geopolitics and political uncertainty are the two leading perceived risks for CEOs around the world. Well, joining me now is John Holt. He's Chief Executive of KPMG in the UK. John, good to see you this morning. So why are these CEOs so confident about a return to work?
Increased productivity. It's different for different businesses. If you take a business like mine, actually we work in a hybrid way, and we always worked flexibly before COVID. We've got much better technology than we used to, and therefore hybrid is still the way that we will work in the future. Other businesses are different, and clearly CEOs would believe that coming back into the office will increase productivity, and that's why I think you're seeing this in the survey.
Obviously, it's a very tight labour market. I mean, that's given a lot of employers no choice but to offer more flexible arrangements for a lot of employees. Does these findings suggest that they think there's going to be an uptick in unemployment?
Our economists would suggest there probably is going to be a small uptick in unemployment. The labour market has become less tight than it was 6 months ago. So I don't think it necessarily reflects through in the survey.
What about your clients and customers, John? Are they happy necessarily not having face-to-face interaction with your people?
Well, the whole point about KPMG is that our people are where our clients want them to be. So if they need to be at client sites, they're at client sites. If they come to the office typically 2 to 3 days a week, then that's what they do. But they also work from home. And for a business like ours, which is a service business, then actually that works very well. That might be different for different businesses.
Your findings, though, have quite a lot of implications. I mean, not least for the office market, where we're told by at least one analyst is currently in a rental recession.
Yeah, albeit as I walk around Canary Wharf, which is where we're based, it seems very, very busy. So my anecdotal perception is that London's getting busier, certainly, and people are coming back into work. I think what this survey shows is that there is a desire amongst many CEOs for that to accelerate. But as I say, different for different businesses.
Well, that's encouraging to hear. I mean, looking at the other findings of your survey, geopolitics is the number one concern. Did you delve into that? Were there any specifics that they flagged? I assume Ukraine is one of them.
Yeah, and look, I also think we've got elections coming. We've got elections in the US, we've got elections in the European Parliament, we've got elections in the UK. So maybe it's just a point in time. What businesses want is certainty. That's the thing that they crave for. Businesses invest in the medium term. And one of the things that's interesting in the survey is that two of the big areas that they invest in ESG and in generative AI, they don't expect to pay back for 3 to 5 years. So these are big investments, but they're investing for the medium term. So you can understand that business leaders are concerned if there is uncertainty, because their payback is the medium term. It's not the next 12 months, 18 months.
Yeah, I was quite struck by that finding on ESG in particular. I mean, did you get much evidence of CEOs paring back on that investment at all?
Not really. I think we're just maturing in our understanding of ESG. And certainly in my conversations with CEO, I don't sense a paring back on the commitment to ESG or the spending on ESG. And interestingly, I think 80% of people in the survey believe that ESG was going to be a value creator in terms of connectivity with their customers, their brand. So, but again, it's a medium-term investment. And I think we're just on a maturity curve, and we're going to the next stage effectively.
OK, John, got to leave it there. It's been a while since we saw you. It's good to catch up with you. Thank you.
Thank you, Ian. Take care.
Now, rental prices have reached a new record high, with average monthly rents 10% higher than they were a year ago. According to the property website Rightmove, monthly bills outside London now average £1,278. Average London rents have risen to a record of £2,627 a month. That's up 12% on a year ago. Well, joining me now is Rightmove's Director of Property Science, Tim Bannister. Tim, welcome to you. This is all to do with the supply and demand imbalance for rental property, of course.
That's right, yeah. Demand is up 40% compared to where it was back in 2019, whereas at the same time, supply is down 35%. So that imbalance that we've seen for a while seems to be continuing, and that's driving just very, very high levels of competition amongst tenants looking for their next home. In fact, we've seen the number of inquiries per available property now as it stands at 25. It was 8 back in 2019, and even last quarter it was at 20. So it's accelerating at the moment.
And yet, to take a positive note, I mean, you note that these imbalances are starting to right themselves to an extent.
So if we're looking for some of those small positives, which I know it's difficult for tenants out there trying to find their next home, it would be that there's a little bit of demand coming off a little bit compared to where we were last year. So last year was exceptionally high. We're down about 17% compared to 2022, although, as I say, up 40% compared to 2019. And stock, we're up a little bit compared to last year, up about 7%, but it was sort of record lows. So things are improving a little, but I think, and that demand for property is improving a little. It'll take a bit of time for that to filter through. So maybe we'll see this pace of growth ease a little, but it's still moving at quite a strong pace.
Why has availability of rental properties fallen away in the way it has? Is it because the government's taken away a lot of tax breaks for buy-to-let landlords? Are they just throwing in the towel?
I think it's a combination of quite a few things. I think that's certainly one part of it. So when we surveyed landlords, they've said, particular small landlords, accidental landlords with one property, it's not quite as economically viable for them as it has been, despite the fact that there's this competition for their product out there. It is, it's more difficult to make those numbers work. So we know some people have been looking to sell up, but we've seen people stay put for longer. For example, people extending their the length of their tenancies, which has also taken stock out of the market, hasn't sort of returned quite as quickly as before. So there are quite a few different aspects which are impacting this, but certainly landlords potentially looking to sell is one aspect there.
OK, Tim, got to leave it there. Appreciate you joining me today. Thank you.
Thanks.
Well, the oil price sold off heavily last night amid all the turmoil in bond markets, and it's continued to drift today, having earlier hit its lowest level since the end of August. A barrel of Brent crude is currently changing hands at $84.48 a barrel. That's off just over 1.5% on the session. On the bond markets themselves, well, things have actually calmed a little bit over the last 24 hours, but yields, which obviously rise as the price falls, remain close to the elevated levels that they've hit this week. On the equity markets, last night's positive session on Wall Street was followed by gains across the Asia-Pacific region overnight. You can ignore the figure for Shanghai. That's closed for the Golden Week holiday. In Europe, stocks, though, have been pretty mixed this morning. There's the current picture. The CAC 40 slightly letting the side down. Most markets pretty much unchanged there, looking at that. One of the big talking points in mainland Europe today is Alstom. The French train manufacturer shares are off 37%. That's after it warns that it will suffer negative cash flow this year. Well, here in London, the FTSE 100 is just about holding its head above water. They're currently 0.5% higher. Gains for consumer stocks are balancing out losses elsewhere. Imperial Brands, which I mentioned earlier in the programme, they're the leading blue chip gainer right now on that trading update, now 4% to the good. While Tesco remains wanted after its strong results yesterday, nearly 3.5% better right now. Among the leading fallers, well, you'll be unsurprised to know that BP and Shell are among them. That's on the lower oil price. BP off nearly 1.75% there. Outside the FTSE, the Ukrainian iron ore pellet producer Ferexpo, its shares are ahead by 4% after a rise in quarterly production, while, as mentioned, Metro Bank remains firmly in the doldrums after confirming that proposed fundraising. It was off 26% when I came into the studio a few moments ago. Elsewhere, Diversified Energy, little small cap company there, down 1.5% after scrapping plans to list in the United States. Over on the foreign exchange markets, look at that. It's all pretty quiet, to be honest. Sterling more or less unchanged against the dollar. It's off just over 1/10% against the euro. Well, joining me today is Janet Murray, Head of Market Analysis at RBC Brewin Dolphin. Janet, good to see you today. I mean, obviously, it's been a tumultuous week in the bond markets, but it's all calmed down over the last 12 to 24 hours.
Hi, good morning, Ian. Thanks for having me. I think it is a bit of stabilization, but I think a lot of uncertainty is lingering and we expect a lot more volatility. I think basically markets are moving on from when interest rates will peak to the readjustment that we are going to be in this higher for longer interest rate environment. And I think markets are more and more thinking about structural issues, particularly in the US, which are budget deficits, which are high issuance of treasury bills, and quantitative tightening. I mean, the Federal Reserve still has to reduce their balance sheet by $1 trillion in the next 12 months. So, these are the reasons why investors are demanding a higher compensation to hold longer dated bonds. So that's why I don't see how this issue is going to resolve until we get more clarity on the economy. And I think the economy needs to weaken significantly before we can even talk about rate cuts.
There's a lot of talk about bond vigilantes being back, the markets disciplining profligate governments in the way they spend. At the moment, I mean, it's no surprise, I guess. Biden is borrowing vast amounts. The US deficit's blown out. Even governments close to home. I mean, the UK government's running a huge deficit. France, everywhere is really.
Yeah, absolutely. I think this political chaos that is happening in the US Congress at the moment is certainly weighing on sentiment and, as a result, prompt investors to be cautious and demand a higher compensation to hold bonds, as I mentioned. And in the UK, we all know that debt is a problem, and we saw that bond yields have risen so much in the past 2 years, and it really weighs on government finances. Just to give an example, last full year, UK paid over £100 billion in interest alone, and that is actually higher than the defense budget, for instance, and the education budget. So it really diverges where that money can be spent on.
Yeah, Janet, I want to ask you about Japan in particular, because Japan's obviously the most indebted advanced economy in the world, and yet they've still got zero interest rates.
Yes, the thing is, the Japanese, the central bank, they hold the majority of the government bond, and they have been having this yield curve control policy that effectively suppresses the level of government bond yield. And they're very reluctant to raise interest rates because they have not really seen inflation for decades. And finally, there's a bit of inflation, but they want to make sure it is sustained inflation, sustained wage growth in the economy before they move. But obviously, they're facing a lot of hurdles, and investors are really scrutinizing them by, for example, betting against the yen. The yen has hit critical levels, 150 to the dollar, and which usually would trigger some intervention. So I think they're under immense pressure to actually adjust that loose monetary policy.
Just explain to people who may not be as up on these things. I mean, people will look at the vast amounts of borrowing in the United States, the UK, France and others and say, well, hang on, Japan's got a much bigger debt to GDP ratio than all of these countries, and the markets don't punish it. Why is that?
Yeah, first of all, as I mentioned, the Japanese central bank holds the majority of the bond. They have been keep buying these bonds, which keeps yields suppressed. And also, most of the debt in Japan is actually internally held, so held by Japanese corporations, pension funds, the central bank, as I mentioned. Whereas, for example, here in the UK, I mean, a lot of overseas investors hold these bonds. So you're, as many people refer to, depend on the generosity of your strangers. So I think Japan is a bit different from the other central banks.
That's right, yes. Mark Carney's famous words, the kindness of strangers. Janet, great to see you this morning. Thank you. Still to come here on Business Live, can the UK become an AI superpower? Don't go away.
They've pushed the protesters further back here. There's around 200 or 300 still remaining.
I'm Dan Whitehead and I'm Sky News' West of England correspondent.
This van goes onto the streets of Plymouth 7 days a week, 365 days a year.
These facilities at the moment are a lifesaver. It's all we've got.
From fishing communities to bustling cities, we spend every day reporting from across the region, hearing from people who have real stories.
I'm going to have nowhere to live for 3 or 4 months.
There are still people inside the properties here.
They're coming from the epicentre of what is now a global health pandemic. We were seeing and speaking to young women who were selling themselves, right on the high street. It was desperately sad, and the fact it was happening right in the heart of this community. Before Brexit, these oysters were being exported to the EU, but the trade stopped overnight.
What's your feeling about the future then?
Blake might all be finished, I don't know.
Fly Emirates. Fly better. Fly Emirates. Fly better. Thank you.
Welcome back. Now, next month, we'll see Rishi Sunak hosting a global artificial intelligence summit at Bletchley Park. That was the site where British code breakers cracked Nazi Germany's Enigma code. Well, the Prime Minister is hoping that helping frame regulation of AI will make the UK a superpower in the field. Well, with me now is Joel Hellermark. He's the founder and chief executive of Sana, an AI-powered learning platform whose customers include the likes of Merck and Electrolux. Joel, good to see you this morning. How do you think the UK is faring in this push?
Thrilled to be here with you, Ian. I think so far so good. What I think we can play a very critical role in Europe is to build these privacy-first AI companies. So far, we've seen companies built around GDPR, and once we go and launch in the US, we've been able to architect our platforms around this privacy-first approach, which has given us a massive advantage as we compete with the US companies that are lagging behind.
Right, so you're quite optimistic something will come out of this summit?
I think so, indeed. And I like that we're taking the lead here, much like we've done historically on data regulations.
Apparently, though, only 100 people are on the invitation list. I mean, a lot of startups are going to be excluded. That's a bit of a mistake, isn't it?
I think so, indeed. I think it's important that we don't only focus on the larger companies when it comes to AI. Very much the next set of leaders are being founded right now, and it's important that we include this in the conversation.
So you mentioned a privacy-led approach there. I mean, there is this sort of trade-off, isn't there, between encouraging innovation and preventing AI from doing harm. How are other countries striking that balance?
I think it's important that we're very specific in these issues. One risk that could happen is if we over-regulate, it's going to be a very costly endeavor for companies to comply with these regulations, which will ultimately play to the larger companies' favor. So I think it's important that we think about the emerging companies as we set up these regulations, and that we're very specific in which issues we go after.
Interesting you make that point, because, I mean, there is this debate, whether AI is going to ultimately end up being controlled by the likes of Microsoft, Google, Apple, Amazon, and so on.
I think what we've seen so far with cloud is more of a democratization. Historically, with cloud, it was very costly to get started. And then with the cloud providers, you could enable companies like ourselves to get started with just a few engineers, not much funding, and we could build this global company based on the cloud. We're seeing the same with the foundational models, where the foundational models are acting as platforms. Those platforms are in turn enabling smaller companies to build global businesses that are built on state-of-the-art machine learning. So largely, I think we will also see that democratization where the foundational models actually become more accessible rather than less.
So for people who aren't familiar with your business, give me a sort of practical application. What sort of things do you do?
One of the grand challenges now is we've seen the benefits of ChatGPT, but when we think about the next wave, it's about connecting ChatGPT to the right context. So as you build models now, you want to connect it not only to all of the world's knowledge, but all of your company's knowledge and all of your knowledge. What we want to build with Sana is the AI-powered knowledge platform that captures all of the world's knowledge, but focuses on capturing your organization's knowledge and then making that available to every single employee so that you can achieve your mission faster.
But not outside the organization, just internally.
Exactly. So some folks describe it as a Google for your company, where we've indexed and organized all of your company's knowledge, and then we make that universally available for every single employee.
And you've just raised $28 million in a funding round. What will that enable you to do?
Now we're excited to be in the UK, and we're scaling here aggressively. We also opened recently in New York, and we think that there's a massive opportunity to build a global category leader in this space. And now we have the funding to scale the go-to-market teams, but equally invest in R&D.
And what's amazing about it, I mean, you taught yourself to code, and you've built an $80 million company on the back of that.
Yeah, so I'm really a result of the MOOCs and all of these courses that came online over the last few years.
Explain what a MOOC is.
So a MOOC was Andrew Ng from Stanford started publishing his courses online, enabling anyone to take them. When I was 13, I came across some of these courses in computer science and eventually AI, taught myself to code, and as a function of that, ended up landing a job as a machine learning engineer.
Brilliant. And how's your hiring in London going?
We're incredibly excited about the level of talent here. We think we have excellent both on the research side, but equally on the go-to-market side. So far, the talent has been fantastic, and we're really excited to invest in the market.
Good to hear. Joel, lovely to see you this morning. Come back and see us again. Thank you.
Thank you very much.
That's it from me for the time being. I will be back with our afternoon edition at 4:30. Hope very much to see you there. My chief guests are going to include Ronnie George, the chief executive of Volution, which, if you haven't heard about it, is a very, very fast-growing company in the FTSE mid 250. Always worth talking to Ronnie. See you later on. Up next, it's Anna Jones. Thanks for joining me today. Cheerio.